make it a little more clear because underwriting has a lot of numbers in it. I don't want to be any more confusing than it already is. All right. So I'm going to start today talking about some of the most important numbers you're going to come across here in the syndication space. The most important thing you are likely going to encounter is this T12. The best way to describe what a T12 is that it's the actuals. It's the true number. It's the number that you really aren't going to see someone try to scam you with, right? Like if you're a syndicator and you're raising money, this is kind of a low stakes number because these are numbers that everyone else has. These are numbers that, frankly, you are using to make sure that you get the correct expenses. This doesn't really change that much, right? Because this is from the past owner. So whoever is the sponsor, whoever's the GP, whenever they take this, they usually copy and paste it into whatever ends up being the proforma in the expense side. And so this is a necessary document, but it's also important because this is where a sponsor will say, hey, we're actually saving a bunch of money because water costs are twice as high as they should. That means there's a leak. We're going to fix it, and then we're going to make a lot of money because we're going to increase our net income. That's how we get the value. I'm going to talk about that later. Then there's also the pro forma statement. This is what the investors use against the property's actuals to create an estimate. The pro forma statement is a statement that shows what you think the property is going to make, both in terms of cash flow and what it's going to sell for over whatever period of time that you purchased it. It's a pro forma because it's projected into the future, right? And so pro formas are where you start to question these numbers because you have to think of it this way. A syndicator is essentially a broker, right? You can't trust everything a broker says. They're incentivized to convince you that it's a good product. You still have to do your own numbers at the end of the day, right? And in order to break down those numbers, we're going to go over a few metrics and definitions that I think are important from the perspective of an LP. We're not going to go over the full Excel sheet, but we're going to read over someone else's. And then we're going to key in on a few things that might be important. Most of the time, no one does anything funny with the Excel sheet. You can only look and see what are the projections and take it off of that. And if they've calculated something wrong, then it's a much harder problem to solve, mainly because that syndicator probably has been calculating all of their properties correctly, in which case then I don't know if you can even trust them for everything else. So that being said, this is one of the most important equations you're going to see in commercial real estate. I know we all don't like math, but this is very important that you learn it. The value of a building is determined by the net operating income divided by the cap rate. Cap rate is this metric that you're going to end up running into a lot. But the best way to explain it is that if I bought $1 million building at a 5% cap rate, I would make about $50K in net operating income a year. Net operating income is how much money I make, not including my mortgage or any other financing costs, right? The idea behind this is that everyone might pick a different mortgage, but everyone has the potential to operate at the same net income, right? When I'm buying a property from a seller, I don't expect the income to maybe change that much, but my mortgage payments might be completely different, right? And so that's why most buyers in the real estate market use a capitalization rate and a net income to determine what the value of a building should be worth on the sale. This is because unlike a single family home where you can say have 6 other buildings that sold in the last 6 months that looks exactly like your property, you don't have another 6 apartment buildings of the same size, unit mix, maybe across the last year, right? That's usually what happens. Obviously, in the last 2 years, that's been a little bit different. So what most people do is they compare the income that a property generates against each other, right? So the net income, again, is that equalizer. It's dependent on how qualified the person owning it and running it is, right? If the last person's operating it at 300K and you look at it and say, I can make it $1 million in income a year, you've essentially tripled the net operating income. That is usually determined by the skill of the operator. There's obviously a bit of the market rent increase involved, but if you can triple NOI, and increase the valuation by 3 times where the cap rate stays the same, what that means is whoever was operating it increased the value of the building regardless of how good the market performed, right? So conservatively, most people will say net operating income is around 50 to 60%. What that means is your expenses are usually 40 to 50% of the building potential profit, right? So what about capitalization rates? Well, this is a number that determines how appealing an asset is. That means both if I have a luxury apartment complex in downtown, Austin, right? That's gonna be a very hot, very attractive asset class, right? And so when you buy that building, you're probably gonna buy it at a lower capitalization rate than if you were to buy a C or D class building in, say, Chicago right now, right? And so when you pick these properties, your cap rate is just a multiplier. The cap rate is what people are willing to pay for it today. The cap rate decreased a lot in the last few years because interest rates got really cheap. And what that meant was people can still make a lot of income because their debt payments weren't that high. And so their cash flow is massive, given how much income they could generate. So they were willing to pay lower and lower cap rates to make it work. The problem now is that interest rates are back up. You have to have a higher cap rate to make up for that. And so typically in terms of capitalization rates, multifamily has the lowest cap rate. What that means is people are willing to pay close to nothing, the lowest amount of income for multifamily, whereas hospitality is typically the highest because usually the attractiveness is related to how passive the operating business is and how stable the income is. Usually in a downturn, people say this all the time, rent stays typically flat because people always need a place to live, but people don't always need a place to vacation. That usually gets cuts first in an economic downturn. And so hospitality typically has the highest capitalization rates, but most people don't buy hospitality on cap rates. They buy it on another multiplier based on revenue. But ignoring that, those are the two most important factors in determining what the value of your building is. It's a net income and it's a capitalization rate. All right. Now, then you might say, why don't I just buy the highest cap rate that I can afford? Well, the problem is the higher the cap rate, usually the worse the asset class is, right? You might be buying something that's a high cap rate, but in a rough neighborhood and not the best city in maybe like retail instead of say multifamily, right? And so you're taking a lot of risk when you buy something with a high cap rate that is already stabilized. The reason I mention this is because your purchasing cap rate, your entry cap rate, only matters if it's a stabilized building. It doesn't matter if you buy something that's a value add, right? The reason for this is, I'll give you an example in a second, but if you look at cap rates, which you can do by asking a broker or somebody who buys a lot of property in the area or the CBRE rate map, you're going to end up buying properties that you can push the income of by a significant amount. So the example I'm going to give is the Sterling at San Marco. That's a building we bought. We bought it at a 2.4% cap rate at $12 million. We spent about $300K, a very small amount to renovate the exterior and then push NOI from $280K to $1 million. Stabilized, our cap rate is now around 7.5%. We might have bought it at a 2.4% cap rate, but given the amount that we could push income to for a very small amount of renovation cost, our cap rate was pushed to 7.5%. But the market cap rate right now for a C-class building in Jacksonville, Florida is around 5.5. And so if we were to sell it, we could probably sell it for around 17, right? And so those are things that you have to think about. The cap rate that you buy doesn't matter on a value add. What matters is what is the final cap rate when you're stabilized, and then what can you sell it for to the next person if you decided to exit. That's how you figure out how much your building is worth, right? So how do people usually underwrite? I've underlined a few important keynotes throughout this presentation about things that I check for as an LP, but exit cap rate is usually 0.1% higher than market each year you hold it. Conservatively, some people will put a whole percent higher than the exit. What that means is if you have a 5-year exit, most people will put 0.5%. However, given the market conditions, I'd be remiss to say putting 0.5% on the exit cap rate would be enough nowadays, right? So if the market cap rate is 5%, now I would say you might turn it to 6%, right? Maybe 4 or 5 years ago, it might have made sense to say, going from 5%, I might jump to 5.5 if I sell in year 5, right? That's what it means to have 0.1% higher on the exit cap rate every year. So conservatively, a whole percent higher is typically what I'm seeing people who are taking very big precautions on the sale price are doing. Then stabilized cap rate should also be higher than your interest rate. Remember what I said earlier, your cap rate is essentially your net operating income. This ignores your mortgage payments. And what that means is if you bought a whole building for $1 million cash, the amount of income you would generate from it is $50K. It's 5%. Your cash on cash is 5% if you bought everything cash. So if your interest rate is higher than 5%, you're almost 100% going to be negative cash flow, right? And so those are the things you have to watch out for. It's okay if you bought it, below cap, below the interest rate. Say, right now interest rates are around 6% for multifamily stabilized assets. If I were to buy a building at 5% cap rate today, but I was like, hey, I can push this to like 8 or 9, then I would say, okay, I feel a lot safer with that number, right? And so that's what I meant when I said your cap rate that you buy doesn't matter. It's the cap rate that you are stable at, and then what you can sell it for. Make sense? So now we're going to talk about a few other metrics. Cash on cash, or ROI. Cash on cash, ROI, is your annual income divided by the total amount of money you invested. Most investors already know what this means, but what they don't take into consideration is return on equity, which is the income divided by the actual equity you have in the project. I know some people are happy to say like, hey, I'm cash flowing, say $1,000 a month. And then I'll have to ask them, well, how much equity do you have in the property? Well, then they say, actually, I have like $400,000 of equity in the property. That's how they're cash flowing in a place like California, right? They must have bought it 20, 30 years ago, and now they have a huge amount of equity, and that's how they're able to cash flow. But anyone can cash flow if you buy a property cash, all cash, right? So it's just a question of how much of the loan is there and how much equity do you have? People will brag about, hey, I was able to burr out of this building. And so my ROI, my return on investment, is like infinite because I have no money left in the project. Well, actually, your return on equity, you've left money in the project when you refied out, right? You might have bought a building and renovated everything for $80. You refied out for $100. The valuation's at $100, but you got all $80 back that you initially spent, but you've left $20 inside in equity. And so your return on equity might even be negative because in a market that has a low cap rate or places like California where it's extremely expensive, by the time you refinance out, your cash flow is now negative because the mortgage payments are so high for a building that's at actual value. And so a lot of investors that I talk to usually have 40, 50% down in their property. That's how they cash flow in a place like, LA or San Francisco, right? And so your return on equity isn't as high, but that's okay if that's what you are investing in. If you wanted to scale up and get more growth, maybe you should go to a different market then, right? So cash on cash does not include the returns from the sale. And the higher this number is, the better your project will likely perform. Your cash is what protects you in a downturn, right? So the higher the cash flow, the more likely it is you survive to the other side. If you run out of cash, that's how people are forced to sell. And that's when you lose all your money in a project if you go into a foreclosure, right? And then if there's a pref or preferred return, which we'll discuss in the next section about structuring deals, well, you want to make sure that whatever preferred return or amount that the syndicator is promising to pay you first before they get paid, make sure each year they can pay that preferred return up or at least catch up in about 2 to 3 years. I say this because I avoided a project that is currently struggling largely because of this reason. And so if you're curious about what numbers though, most value add syndicators will target 6 to 8% in cash flowing markets. It's been lower recently. I've seen people trade at 4. but this usually 2 to 4% is like Class A buildings. And so, but it was 6 to 8 for a long time. And then development projects will typically not have any, as a project doesn't have income until the building is finished, right? Every asset class has its own set of cash on cash or say, IRRs. I'm going to go over the next term, which is hopefully easy to understand. It's annualized average return. This is what happens when you take your total returns and you divide it by a number of years. If I made 100% return divided by 5 years, that's 20% annualized return. This has been really popular because cash flow is super tight. And so syndicators in particular have been using this number instead of IRR because it looks better to average it out over the several years, because the assumption is that on the sale, you can get a better valuation, even though the cash flow might be low. But this does not account for the time, speed of money, right? This is only accounting for everything added up divided by whatever number of years it took you to hold. The number that actually takes time into account is called IRR, or internal rate of return. The function's kind of complex, so I'm not going to go too deep into it, but what it means is getting money today. For example, if you got paid out 10K over 5 years, would you rather that, or would you get all 50K at the end of those 5 years, right? You kind of want some of that money earlier. You don't want to wait until the end. And so IRR accounts for that. A project that pays you out faster gives you a better IRR than a project that pays you way later on down the line. You want that money as early as you can. So typically it's around 15% for value add, but I've seen people go as low as 12, 13% now because the market's tough, interest rates are high, and it's harder to project those same returns. And then 20% for construction. Typically this is because construction is riskier, but you also exit faster. So that final big payout happens in year 3. Most syndications for value add multifamily take about 5 to 7 years, which is why construction projects will usually have a higher IRR. And then the thing is, IRR is a number that's pretty easy to change depending on how you adjust your market rent growth. So usually I try to keep it, below 3%. Some people go higher, but you usually want them to justify why they can achieve that number. And I'll explain that a little more in this next project that I avoided. So this was a project that I was asked to raise on over a year ago now. This was a Class D apartment complex in Austin. And so the numbers always change depending on the asset class, but to some degree, you still have to care about what the core principles are of every project. And so one thing that I saw was, this is a Class D building. And they were trying to proclaim that on the sale or the refinance, that they could exit at around a 4.38% cap rate. Right. And so, I can see that they were using some pretty risky numbers here, right? Usually you want at least 0.1% increase every year for your cap rate. So if you were to sell it in year 5, for example, I might say this cap rate should be 4.8% instead of 4.4%. But that wasn't what this syndicator did. They just tried to exit at 4.3, 4.4, which for a Class D building was unheard of. Most Class D buildings usually sell for 6 cap. In Austin, it was maybe like 5, even when during standard times, right? And so to try to argue that you can sell it again at, this cap rate is a little aggressive, right? And so that made me a little cautious, because what they're saying now is, if we purchase this building at 16 million, we're going to refinance out $7 million more, or 25% higher. This was late 2021, mind you. So the assumption that Austin was going to grow another 25% in valuation probably wasn't complete unfounded, because it had grown 30, 40% the year prior, but it just seemed really excessive that I didn't think it would be able to be pulled off again. And so the realistic cap rate part was something that everyone has to consider. When you look at retail buildings or commercial buildings, oftentimes they're 7-8% cap rates. Multifamily has typically been lower, like I said, because it's a safer asset class. But even then, most multifamily, especially C class, has hovered around 5-6%. And so to argue that it'll stay at 4% in 2-3 years on the refi, much less the sale, was a very aggressive proposition that I just didn't think was going to happen. Right. And so that's what I meant when I said, try to figure out what a realistic cap rate is. Even if they went with the standard add 0.1%, I felt like 4.8% probably wasn't enough. I would have underwritten all the way to at least 5.3. And when you include 5.3 as the exit cap rate, the valuation drops immediately on the sale, and all of a sudden your returns disappear, right? I also didn't really see a realistic sales comp. What a comp is if you ask them, hopefully this syndicator has this, what are other buildings selling for per unit? 144,000 was the highest at the time for this neighborhood that I'd ever seen. I know this because we had actually bid on the same exact building ourselves a year earlier at around 13 million. We put in an offer for 12.2, and the seller said, I want 13 or else I'm not selling it. And so we passed on it. But this group bought it for 16 million and said, we're getting it for a steal, right? And so that gives you an idea of why I was very cautious. But on top of that, so a Class D neighborhood, you're going to argue that it's going to jump all the way to 200,000 a unit, right? Those are condo prices almost. And so that just became very unrealistic in terms of what could be achievable to me, right? And so you don't really see this until you start seeing more and more deals in an area. That's why it's nice to talk to multiple syndicators that operate within the market you're trying to buy in, right? I also wanted to see more realistic rent comps. I looked back at their building recently. They originally purchased it at around 1,000 a unit in terms of rent, and they were going to push it to around 1,300. I looked at their website recently, and you know they're starting to get 1,350 on some of the units, but it's definitely not their average number. And so somewhere in the middle is probably around 1,100 across all the unit mixes that they were getting in terms of rent. So the reason I got scared about this was because the place that they bought the building was Windsor Park, but it's close to this neighborhood called Mueller, which is a Class A brand new development. It was honestly like a 6-7 minute drive. So they're not wrong. It's very close. And there's a chance that that could grow beyond and then increase the valuations. But the disparity between the two neighborhoods was very significant. And it made it not that believable that maybe, you know, you could really push those numbers. But that being said, this wasn't actually the scariest thing. I've seen plenty of projects where people push rent by like 30%. It's just that these operators weren't able to pull it off. Another red flag that I encountered was this is actually not that big of a problem, but something that's more of a pet peeve. Typically, you want to see market rent growth under 3%. Market rent growth is different than the property's growth to the comp. What that means is I have a building and it's getting 1,000 in rent a month, but my neighbor is maybe getting 1,200. So that is value add rent growth, getting from 1,000 to 1,200, because I'm just going to match what his units look like. However, natural market rent growth means his building and my building both go up 10% this year in rent because of inflation. That's the market rent growth. But you can't project 10% rent growth forever, because then every deal is a deal. And so 3% is typically kind of the max people want to see. That's realistic. Some people put 4 every once in a while, and they usually front load it, which makes the IRR look bigger because you're starting from a higher rent increase at the beginning, right? The thing that pet peeves me though is oftentimes people will include other rent growth and then also only put say 2 or 2%, a lower number for their costs. If you put 6% rent growth, for example, because you're trying to be realistic, I want to see 5 or 6% growth in your expenses also, right? You want that number to be realistic. If you're trying to account for inflation, well, you have to be able to explain those numbers. And so the rule of thumb historically has been keep market rent under 3%. That's more realistic. And then inflation, maybe you set to 3 or 4, because that's what inflation actually is today, right? You want to be conservative with your projections, but also match it to today's expenses and what inflation looks like. I mentioned this earlier, you want your expense ratio to be around 40 to 50%. This Excel sheet I know looks a little complex, so I'm going to carve out the parts that are important. To calculate expense ratio, what you do is you figure out what your total income looks like in terms of revenue, and then your expenses are just going to be added up. This is the T12 portion. Someone else has likely already calculated, added all those numbers in together. So this usually doesn't actually take that much work. It's just looking at the total expense section. So when you do the math here, they were estimating around a 50% expense ratio. This is pretty normal for a D-class building in Austin. Texas has much higher property tax rates. And so an older building is much likely to get higher on that 50% range. Whereas us in Florida last year, we were operating around 43, 42% expense ratio, but we still underwrote at 45, right? And so you want to be careful about how you estimate your expense ratios. It's just to be conservative, but typically 40 to 50 is the range. The higher property tax, the higher to 50% you likely are to be. I also wanted to see them account for insurance and tax increases. Everyone does this a little bit different. Insurance is a little harder to estimate, especially in a market like Florida. So rule of thumb for us right now is like $2,000 a unit for a year. Whereas with property taxes, most people say 95% of the purchase price times the tax rate. That's usually the estimate for what the tax looks like. And that's a jump in the first year. This is more of a problem because in the last few years, a lot of people have been purchasing buildings that have jumped significantly in value. So that new appraisal can sometimes wipe out cash flow after year one, year two. And so you want to make sure that both insurance and property taxes are adjusted for the future increases. In terms of property tax increases, though, in Texas, it's largely related to the price. And so a lot of buildings in Austin have seen something close to like 25, 40%, depending on how much the building value increased on that purchase. In terms of insurance, they've also gone up. It just depends on where you're buying and the asset class that you have. Class A buildings usually have a lower increase in terms of the insurance cost. Class C buildings typically cover the brunt of it. So they also forgot to include reserves in their underwriting. Usually you want to see around 250 to 350 a unit. This is usually required by the lender as well. So I was a little disappointed it didn't include the reserved budget costs. This usually helps with your capital expenditures and et cetera, but it helps also because you're going to be even more conservative with this. 250 to 350 depends on your lender, and then also is it an older building or a newer building? What type of tenants are you getting, right? And so that's usually what determines where the reserves are per unit. This is what killed them, though. This project is currently struggling, and they have already done a capital call, and they likely are forced to sell it this year because they're not going to have enough money to refinance, do another capital call, or purchase another rate cap, which I'm going to explain in a second. But economic vacancy is not the same thing as physical vacancy. Economic vacancy includes loss to lease. What that means is I might have a tenant today that just signed a lease for $1,000. In about 6 months, another tenant signed a lease for $1,200. So I can't just kick out the tenant from 6 months ago that signed at $1,000. That difference of $200, that's a loss to lease, right? This is where the market's at. This is where they're signed. But because leases are 12 months long, you can't renew and get closer until the lease expires. And so usually loss to lease is a lagging number that you have to catch up and fix. So in order to calculate economic vacancy, the biggest problem I saw was they initially calculated a year one loss to lease vacancy, or sorry, economic vacancy of around 9%. We usually budget around 25. The first year is the most difficult because that's when all the renovations are happening. In that period of time, think about it from a single tenant's perspective. We have to renovate the unit. That's, maybe 2 weeks, 3-4 weeks. Then you have to find the tenant to fill it. So that's maybe another 2 weeks, 3 weeks, right? And so that's easily a month and a half just gone trying to fill a tenant. you only have 12 months in a year. So I'm already down 12% economic vacancy just trying to swap out a tenant on the renovation, right? Sometimes renovations go long. They might take a month long instead of just 2 weeks. You know, sometimes it takes longer to find a tenant, right? And so those aren't things that are being properly budgeted for in that first year. And so that's why 24% is pretty important, because you might get some surprises in your renovation. You also might get some surprises in terms of tenants who can't pay rent on time. They didn't account for any bad debt. Bad debt means tenants who leave and then they owe more money than the security deposit's worth, right? And the problem with this building in particular was they had a lot of tenants that needed to be evicted. These numbers aren't impossible to hit on a Class A building. They're kind of hard to hit on a Class D building. And so this is a building from the 60s. They spent all their money trying to push out tenants that they blew through $2 million just paying their mortgage and trying to get the tenants out, right? And so they got stuck and they couldn't really do anything else with it because their tenant base wasn't the best. And so they had a harder time attracting good tenants as well because they didn't spend any money doing actual rehab. And so they ended up slumlording it for a while. And so this is what killed them. They spent all the money trying to evict, but they couldn't really raise rents other than what market rent was increasing. In Austin, that was like 20% last year, right? But they also didn't budget for people who would just leave and then not pay their rent enough. That's what bad debt is for. Bad debt is typically 2-3%. Sometimes it goes as high as 5%, but averaged out across a whole year, anytime it's over 5%, you really want to question like what's going on here, right? So this is what squeezed them after their issues with the evictions. So they have, I'm going to explain a few debt terms, and I'm going to go over what they did wrong. Agency versus bridge. Bridge is often needed in order to get agency debt. They went with the bridge loan. Now, you go with the bridge loan because usually it's interest only. So your debt payments are smaller, but none of it goes to your principal, right? So what that means is if you have a 7% interest rate, you're only paying 7% of the loan. You're not paying all the other stuff that comes with a mortgage normally, right? And so rates are interest only on bridge loans, but they are also variable. So that means they can adjust up and down. They bought it when it was 3.5%. However, they were smart and they got a rate cap that limited the rent, or I guess that limited the interest rate increase up to 5.5%. And so they're safe, but the rate cap only lasts for a year, which means they have to buy another one, but they're out of cash because they spent it all trying to evict tenants. And so within a year's time, they're gonna have to do another capital call. Then you're also gonna have to worry about, then the issue was the down payment and loan to value. Right now, it's almost 55% for an agency loan, but significantly cheaper than the bridge loan debt. Everyone got scared with the bridge loan market recently. And so people are trying to send their money to safer, stabilized buildings. Whereas bridge loans are usually what's purchased for buildings that aren't that safe. So this debt was also recourse, which means they owe a bunch of money if this project doesn't succeed, because they are putting their own personal money into it, but it got a lower interest rate. Whereas non-recourse, that's what you sign on a multifamily building that says, if this project fails, you can take the building, but you can't go after any of my other assets. That's what non-recourse is. And then prepayment penalties. This will affect the refinance and sale. They got a really low prepayment penalty because the anticipation was that they were going to refinance out into an agency loan at some point. All right. So debt service coverage ratio is a very important number. This is what usually determines when someone picks bridge versus agency debt. The debt service coverage ratio is your net income, your NOI, divided by how much you have to pay in debt. And usually this number has to be higher than 1.25. The bridge debt came first because it's cheaper. in terms of how much down payment you have to put, right? It's a higher interest rate that's floating, but because you're interest only, your DSCR is lower. Your debt obligation is lower. You're only paying the interest part. You're not paying any of the mortgage principal. You're only paying the mortgage interest. So because of that, you can put only 25% down instead of say 35, which is what agency used to be back when when they asked me to help raise for this project. Bridge debt also works great for properties that aren't stabilized. Stabilized for multifamily means 90% or more occupied for the last 3 months. And there's no prepayment penalties, right? It's called a bridge loan because it's supposed to bridge you to the other side in order to get to an agency loan, which is long-term debt. It can be interest only, but you still typically have to put a higher down payment because eventually you have to pay the principal portion of it. The building also must be stabilized. What that means is 90% or more occupied, 85% economic vacancies allowed, or 15% economic vacancy is allowed as well. And these are typically pretty expensive to exit. They come with a lot of prepayment penalties, but the idea was that you want a long-term debt, right? That's what you're headed towards with this bridge loan. That was the goal. The problem is it's higher net income divided by debt obligations. And the problem with this building was that they were newer operators. And so they bought this building and then didn't increase the net income by enough. They were hoping the cap rate just kept falling, and so the valuation would go up. And now they're stuck with higher debt obligations because the interest rate has gone up, but they didn't push income enough over the 1.25 point. And so because of that, instead of when they put 25% down on the building, well, now in order to refinance out, they need 50% down on the next loan. And they have to get that either through raising money, or they just wait it out and then buy another rate cap. But they have to raise money again for that from their investors. Pretty much they're stuck unless they decide to sell. And they have to sell because on a bridge loan, they're short term. They're only 2 to 3 years long typically, with extensions maybe to add 6 months or a year. When the bridge loan matures, the bank says, I want the rest of my money back. If they don't get the money back, then they foreclose. So you're stuck in a rock and a hard place. If you can't raise more money to get to the other side because you didn't have enough cash flow, then you're going to have to figure out, how do I raise more money for a rate cap, for a refinance? If I can't do both of those, I'm just going to have to sell right now. And the problem is a lot of people are in this situation, which is why you're seeing multifamily valuations come down. The cap rates are going up because a lot of people have to sell the building, but no one's going to buy it anymore at a 4 cap because the interest rate is way higher than that, right? And so when this building was purchased, most of these bridge loans are attached to an index that's floating. SOFR is one of the rates that we've been attached to as a floating rate. So SOFR, back when this project was first pitched in late 2021, SOFR was only 0%. So it's usually 3.5% plus whatever SOFR is. So it was probably like 3.5% at the purchase. It's now almost 5%. That means the mortgage payments have more than doubled, right? So if you've more than doubled your mortgage payments, did you more than double your net operating income? Because if you didn't, you're not going to be able to refinance out properly, right? So that's a DSCR portion, right? Remember, net operating income divided by debt obligations. Well, if your debt obligations have doubled, your net operating income has to double just so you can exit as well. So that being said, that's the end of the presentation for the underwriting portion for LPs. Any questions I can tackle? Okay. Anywho, I wonder how much it would cost for them to extend their loan versus refinance to agency debt. It depends. It depends on how much their net operating income is, because that will determine how much they can refinance out of. right? And so their loan to value, or at least their debt service coverage ratios, it's a little hard to figure out without seeing their exact books. But what I can tell you is there's a very little chance they managed to double their net operating income despite how much debt obligations have increased. Paul Kim, what has property tax insurance and insurance increase been in Texas? Either extending their loan doesn't happen on a bridge loan necessarily because the way that the loan is structured, it's supposed to end at a certain point. There's a maturity date. And so the extensions will eventually run out because the lender wants their money back at some point, right? So Edison asks, how do we as an LP vet out the assumptions of a syndication's pro forma are good assumptions? Well, I just gave you a small list of them to go over. If you're curious about more, we were sponsored by Palace HQ. It's a good way to interact and engage with other syndicators and then ask them, how are they creating their assumptions, right? And once you get an Excel sheet that you ask for from whatever sponsor that you're trying to invest with, you can run that oftentimes against other syndicators because, again, remember, they're all brokers. They're all trying to get your business to some degree. And the most honesty you'll probably get about a project will probably come from a competitor, right? And so that's what I meant when I say, I guess, like, how do you vet out assumptions of a syndication are good assumptions? I would double check on Palace HQ. That's likely the place that I would go just to ask other syndicators what they're looking at. And so this is a way to gauge and see what it looks like across the investment horizon. Otherwise, you are also just kind of shooting blind and hoping the first person you run into is someone you can trust. All right, so that's what I would suggest. Let's see. Paul Kim, what is the property tax and insurance increase been like in Texas? It's been quite brutal for the insurance in Florida. Our insurance costs 1.5x, but if you were closer to the water, some people 2 or 3x on their insurance costs. And so that's what I know for Florida. For Texas, property taxes went up as much as the value of the building went up, pretty much. And so that was a little more predictable. So it was around 20 to 30%, depending on which market you were in. I know Austin went up by that much in the last year or so, but then it dipped again. Year over year, it's down 10%. But people who purchased had to see 20, 30% increase in the property tax appraisals likely. And then Dallas is probably like a smaller amount, and then Houston, an even smaller amount than that. So it depends on which market you're in and how much that market is appreciated since the property was last sold. How do you estimate the cost for insurance and property taxes or the increases for future years when underwriting? So here's the fun part. Typically, when you already sign up for insurance or property tax, most of the time, the same policy or the same holder of the LLC won't see as high of a jump as someone getting a brand new policy. The problem is you can't really estimate for the cost. This is why reserves are important. This is why trying to be conservative is important, but it's a hard thing to project against because no one knew that Florida was going to hit by 2 hurricanes in a year, right? If they did, all the insurance companies would have left a long time ago to avoid having to pay out those premium costs. Same thing with property taxes. Usually this one's more projectable. You just base it off of what the value of the building is. The problem with this is in recent years, this has actually hurt returns for sellers in Texas because the value might have gone 40% up on a single family home, but you can only go up 20, 30% on a multifamily building, but then the taxes come up to match it. And so your expense ratio catches up with you. Whereas in Florida, our revenue increased significantly, but the property taxes, because it's a lower percentage of the expense ratio, it actually decreased the overall expense ratio. That being said, insurance is also up. So there's always a counterbalance between the two. And it's really hard to project into the future, but that's why reserves are important, being conservative is important. I think Perry's in this chat. Perry, how do you project against typically higher property tax or higher insurance costs that you don't know for the future, not just year one, but future.
I I'm actually washing dishes, but hi everyone. We work up to 85% of the purchase price on year 3. And so initially we may start with 50%, then the next year 65%, the following year will be 75%, and the third year will be 85%. And so that is a good rule of thumb in Texas.
Well, it's like the man said, good rule of thumb. Can everyone hear me?
Yep, we can hear you.
Okay, about that. Let's see, our increases for future and underwriting. Are rate caps indicated in the underwriting? Typically, no. That's usually something written out. I haven't seen people usually keep this in the underwriting, but I have seen people try to project what future rate increases look like. This group, for example, that asked me to raise, they were projecting a refinance interest rate of around 5.1%. And right now it's close to 6. So as you can see, it's very hard to project the future. On Facebook, Penguin asked, does a recourse loan only affect the LLC if they set up correctly from the beginning for the loan guarantor? Recourse loans only affect the LLC, correct? From the beginning. Whoever the loan guarantor is, you still have to qualify for the loan. That means your income and your net worth has to be higher than the cost and enough liquidity to support the loan's qualifications. But if the project fails or at any point the value drops below a certain point, because it's recourse, they can't go over your other assets to make up the difference. So say you bought $1 million building, it drops to 500,000 in value, but the loan you took out was maybe 800,000. That means the lender wants $300,000 back. You can go tell the lender to kick rocks because I took a non-recourse loan, so you don't have to do anything with it, right? Even if you set up an LLC, but you sign a recourse loan, you are still on the hook. Usually you sign a personal guarantee that regardless of how the LLC is set up, they can still come after you for all your assets to make up the difference. So that's the difference between recourse and non-recourse, especially if you set up a recourse loan and, you know, sure, you can hold everything under the LLC, but they usually make you sign a personal guarantee document with, you know, with a notary to make sure that you actually pay them back if the value falls below a certain amount. Let's see, Vivian asked, does ROE take appreciation into the equation? No, it does not. Return on equity and return on investment does not look into the future. It only looks on the past, right? And so ROE is really a metric of, yes, maybe you might appreciate some more. And so if you're in a market where you have, you know, lower ROE, that doesn't necessarily mean that's safe for you though. If it's a negative number. If you're okay with 1% ROE, then that's good for you. But projecting into the future for appreciation, that is something that if you could do that well, then you know, you hopefully become extremely rich one day. But I haven't seen anyone do it 100%. So that's kind of why I would say appreciation is a little hard to project in the future. In fact, the reason why most people underwrite to have a lower cap rate on the exit is that it actually removes appreciation. It's saying the value is going to depreciate from the day I buy the building today. And that's what conservative underwriting looks like. Annie, is there a rule of thumb for a healthy amount of reserves that you'd like to see, like percent of a purchase price? Typically, the lender's going to set this for you, but in terms of a healthy amount of reserves, it really depends. For a while, right after COVID started, a lot of sponsors were required to have a interest reserve that they would pay out of, and that was the amount that they would have to raise on top of whatever returns that they were projecting. And so in terms of a healthy amount of reserves, it depends, but rule of thumb, any renovation costs, add 25%, right? That's usually the biggest risk when it comes to healthy reserves. Everyone has a different number for this, but 25%, for example, sometimes isn't enough, especially given how much inflation increased construction costs back in the pandemic. And so I know a lot of sponsors who got caught with that. So it's really hard to say what the right amount of reserves is. But typically, most people fix that by putting a higher down payment, or they just increase the monthly reserves to match it. With the loans that are struggling now, can they just stop their renovations and use the CapEx money to go towards a refinance? Not exactly. It depends. If you have a construction loan, for example, that's capital that you can draw on, but you can't use to necessarily exit into the next building, right? And so lenders will do the same thing. A lot of our CapEx, we have to ask the lender to get our money back from the reserve pool to actually spend on CapEx. And so, that's something we have to do pretty constantly. It's like, hey, we just fixed an AC, send a request to lender, get just $8K back of like the $300K budget that we took, and so, but yeah, you can stop renovating and then try to use the CapEx money to go towards a refinance. So, sorry, yeah, you can't necessarily just take the money from the CapEx to go to refinance unless they raise the CapEx money separately from the purchase. So this is what I've been seeing a lot too. A lot of syndicators aren't able to raise the full amount for both the purchase and the renovation. So last year, what I saw was people only raised the amount to buy the building, and then they kept raising money in order to get enough money to renovate the building. And so if you have that, then yes, technically you can take the money that you had reserved for capital expenditures and renovations and then use that as part of your refinance. The problem with that is a lot of people probably didn't have that because you could go lower when you had bridge loans. It was cheaper to do that. And so the people who are struggling on their loans aren't the ones who did that. The people struggling with loans are probably people who borrowed bridge debt, and then they also borrowed the construction portion with it as well.
I kind of have one more question. I'm not sure if it makes sense, but based on what the refinances are looking like and the interest rates going up high, it feels like even operators who were doing well, it sounds like they could still get screwed over by this. Is it true? Like, even if they were trying to do well, like as in fixing up on what they're supposed to do and keeping up high, but with the interest rates going up so high, if they don't have their rate caps, it sounds like they can still get screwed over by all of this refinance and not making it to that level for that refi agency debt.
No, that's definitely true. And so the question then is, can you get a rate cap in time? Can you refinance out fast enough? We're well past that point. And so plenty of people who were conservative, who did the right thing, they kind of got screwed over. I can't say I know necessarily what the best way out for them is, because at this point, if they didn't buy the rate cap, which was the insurance for them ahead of time, or if they didn't push their income high enough on a project, it's a little hard to say what the best option is, but those are usually things done ahead of time to protect yourself. So.
And do we, as an LP who are investing in these new projects, is it appropriate for me to ask what kind of loan structures or like the interest only things and whatever they have on that?
Those are things you should ask for sure, especially once you get that underwriting. That's why we went over this section. You should ask that syndicator to double check what those numbers are. The ones that I showed earlier, those are pro forma numbers. Everything else is harder to say because those are projections versus the numbers that actually you can't really know. The reason I mention this is because T12s don't usually change, right? Comps don't usually change that much. Those are not things that people can necessarily manipulate that easily. You can obviously check them to be sure, but the things people tend to manipulate are projections like where vacancy ends up, economic vacancy, where future rent growth is going, where et cetera, et cetera. And so one thing I want to see, for example, is if you say I want to have 6% rent growth, well, why don't you have 6%, cost of expenses go up, right, to match it. And so really it's about like, can you explain the numbers properly? And so what you're watching out for is someone being overly idealistic with these pro forma projections, not the existing T12 numbers that you already have.
And then how about because I heard some people say that if you're not investing much or something that, or bare minimum, and the syndicators just don't want to give you those numbers. Is that true?
That's definitely true. So it's a little hard to say, but a good syndicator will probably have it ready. Yep. So Perry said here, a good operator is proud to show you all their risk mitigation that they have, right? And so if you're looking through their numbers, they will be able to explain them. But on top of that, they probably prepared it ahead of time to show you what they're doing to protect from downside risk. And they're good syndicators who definitely skip some steps in terms of rate caps. That's what caught them off guard, and then now they're stuck not being able to refinance. I can say it's not necessarily their fault, but they probably should have heard it coming from the Fed a while back. And so it's expected to ask. So, and if they don't want to show you numbers, honestly, you have other options. Just go to Palace HQ. There's a lot of syndicators on there who will give you those numbers. All right, thanks y'all for showing up. This is we're on the hour. We're gonna get this uploaded, and hopefully I'll see you guys at that South California barbecue trip, and then also SARECon. Hopefully we'll have one last class next week, and then after that, that's the end of our session. We're gonna put these recordings and then organize them more professionally into YouTube later on. So hopefully you guys got the most you got out of it. But if you have more questions, please send them our way so we can know how to adapt and improve on this class. All right, thanks y'all.